How does additional paid in capital APIC relate to cash flow from stock issuance? Have you ever wondered how the money a company raises from selling stock connects to its financial statements? Let's break it down, focusing on additional paid in capital and cash flow from stock issuance. First, what is additional paid in capital? This term refers to the amount investors pay for shares that exceeds the par value of the stock. The par value is simply the face value assigned to each share. When investors buy shares for more than this par value, the extra amount gets recorded as additional paid in capital. Now, how does this relate to cash flow when a company issues stock? When a company sells stock, it receives cash from investors. This cash inflow is recorded in the statement of cash flows under the Section 4, Cash Flows from Financing Activities. The total cash received from stock issuance includes both the par value and the additional paid in capital. For example, let's say a company issues 100 shares with a par value of $1 each, but investors pay $10 per share. The company would receive $1,000 in total. Out of this, $100 would be recorded as common stock, which is the par value. The remaining $900 would be recorded as additional paid in capital. In terms of cash flow, the entire $1,000 counts as an inflow from financing activities. So, while additional paid in capital itself does not directly representing cash flow, it is part of the overall equity structure that results from stock issuance transactions. It shows the premium investors pay over the par value, contributing to the company's total equity. From a tax and accounting viewpoint, understanding additional paid in capital is important for accurately reporting equity transactions. It helps distinguish between the nominal value of shares and their market value, which can impact financial reporting and tax obligations. For instance, additional paid in capital can influence earnings per share calculations and dividend distributions, affecting the total equity base of the company. In practical terms, companies use additional paid in capital to account for the excess funds received from stock sales. These funds can be used for various business purposes, like expanding operations, paying off debts, or investing in new projects. This can indirectly affect cash flow by influencing how a company allocates its resources and manages its financial obligations. So, when you think about the connection between additional paid in capital and cash flow from stock issuance, remember that it reflects the funds raised above the par value and plays a role in the overall financial health of the company. Understanding this relationship is key to grasping how companies manage their finances and report their performance.